first up, let's talk about the rise and the spike that we have seen in global bond yields. I think it really spooked people quite a bit, because usually a surge in bond yields is looked at as a threat to the equity market's rise and economic revival as well. In the US, yields spiked to 1.6%, a one-year high. In Japan, they rose to their highest since 2016. In Germany, rose to an 8-month high, and back home to a near 10-month high. That's, well, almost pre-COVID levels. Now, why exactly are they rising? Well, firstly, global central banks have loosened their monetary policy, as we know. The vaccination, though, has risen expectations of a strong economic recovery. So investors are fearing now that the central bank will soon begin to tighten rates, perhaps, and that will, begin normalizing liquidity as well. Further, remember that a rise in bond yields signals a rise in interest rates in economy. Yields also reflect government borrowings, which will fund expenditure. Borrowing costs in turn will hurt companies' profits as well, their ability to service debts, which may impact profits. And then they may start impacting equities as well if earnings do not catch up. So all of this is a little far-fetched. What we want to try and understand is, for you, the consumer, for you, the retail investor, how do these bond yields make a difference? Should you be tracking them, with us? So joining me now on the show is somebody who understands this entire bit extremely well and will be able to break it down for all of us. Kirtan Shah, Chief Financial Planner with Sykes and Ray Equity, joins us now on the show. Kirtan, thank you so much for taking out time today to talk to us about this. So let's start off with the question that I asked right at the end. For a retail investor, do they really need to be keeping track of how the US, or rather the Indian 10-year yield moves? What is the impact? And also, let me also add in one more question. Me as a consumer, how does this yield really make a difference to the common man in general?
Mubina, thank you so much for inviting me on the show. I think, Mubina, before I answer that question, I think it's imperative that the audience understands the background a little well, because if they don't, they will not be able to relate to this thing. So look, what ideally happened is when COVID came, economic activity came to a standstill. Like you rightly mentioned, globally, all central banks loosened their monetary policy, and which is why they got down their lending rates to as low as possible, so that more and more individuals, more and more companies can borrow a lot of money, and that can give rise to economic activity. Now what happened is, imagine a situation in the US where interest rates are available to you, rather money is available to you at 0%. The government is giving you money as stimulus. Government is buying back bonds from financial institutions. So corporate, retail, and financial institutions, everybody had a lot of money. But while they would go and invest in the market, the rates were close to zero. And which is why they did not have option to invest anywhere else. And that money actually gave rise to risk on, and that entire liquidity came to the equities market. I was just reading over the last 4 months, some $4 billion worth of equity inflows have come to global equities. I think that is one reason why markets have risen. Now, given this background, I think, look, as a retail investor, because you are in this for a long-term investing, and I'm hoping these short-term movements here and there should not matter to you at all. But of course, if you want to understand how these markets in the shorter term impact, then the answer is very simple. They are inversely related. What I mean is, look, economic activity in India, like you just mentioned at the start of the show, is picking up. Globally, also in the US, economic activity is picking up. And which is why there is an expectation that if economic activity is picking up, there is no sense to keep the interest rates low or close to zero. So imagine a situation if interest rates in the US starts going up, right? Which was the prime reason a lot of this money came to India in terms of investments, because in the US, the interest rate was close to zero. So if interest rates in US start increasing, then it becomes less of a reason for the investors globally to put money in emerging markets if they are going to get higher interest rates in their home country, which is one fear in very basic language that the market has, that is, the markets have risen over a period of time because so much liquidity from the global markets came in, And now if yields in the US shoot up, this global liquidity has another place to park their money, which is fixed income in their own country. Which is why the expectation is that probably in the near term, a little less money will come to emerging markets, and because the markets are so richly valued, probably it will not be able to support the equities market. I think that's the context in which the markets have fallen over the last couple of days, in the fear that the global yields are rising.
Okay. So that explains perhaps a bit of the fall in the equity markets. Imagine if you are in America and you're seeing that your own country now could give you better interest rates. Why would you send your money then to emerging markets like India? So that explains why equity markets have fallen. But Kirtan, for maybe debt fund investors, you mentioned, by the way, that for long-term investors, it really shouldn't matter. For someone who's invested in debt funds, how does a spike in yields make a difference to him for different categories of debt funds?
So, Mubina, for this, we have to understand a very basic concept of how the debt market operates. So, ideally, what happens is when yields or interest rates move up, debt funds or bonds typically end up losing some value. The concept is very simple. Imagine you've parked some money in an SBI fixed deposit at 5%, and then 6 months later, the same fixed deposit pays you 6%. Then the 5% bond or the fixed deposit that you held will go down in value, right? So similarly, if yields go up and these funds are still holding the older, lower coupon bonds, they will end up losing in value. Which is why when yields go up, bond funds actually start losing some money mark to market, right? Now the impact is not the same across the spectrum. So if you are invested in funds like ultra short term, low duration, which have lower modified maturity, modified duration or lower maturity, the impact on those funds are less. The impact on funds which are medium term funds or long duration funds are slightly more. So having said that, let me give you an example. So if interest rate moves up 1%, right? The mark to market loss in an ultra short term fund or a low duration fund may be 50 basis points or 0.5%. But at the same time, if yields go up 1%, the mark to market loss in probably a long duration fund may be as good as 3 to 4%. So depending on where you are invested, the impact may be felt. So in my opinion, if yields are supposed to move up, I think investors are better off staying invested at the lower duration, which is the ultra short term liquid funds or the lower duration of the money market kind of funds.
Okay, so when yields spike, you would perhaps be better off, or rather the impact that ultra short term and low duration bond holders will feel will be lower. But for medium and long duration funds, there can be quite a large impact. So that is something that Kirtan, I hope all our viewers as well sort of understand this. Kirtan, largely then, if yields are going up, would the expectation also be that there is maybe inflation in the economy in any manner? Because that's what we are seeing right now. So for the common man, is it also an indicator that, his or her expenses in general are maybe going to go higher?
So Mubina, that's how it works. Actually, inflation, yield / interest rates, they are directly proportional and they move in the same direction. So ideally, the way macroeconomics works is if you are expecting inflation to rise, is when the central government would try to tighten the monetary policy, right, by increasing interest rates. And because markets are forward-looking animal, they would typically price this in earlier before the central bank actually increase the interest rates. So to answer your question, yes, before the interest rates are increased by the central banks, because the market is expecting economic recovery and hence probably inflation going up in the future, it would discount it currently right away, and which is why you see that the yields are spiking.
Okay, so essentially yields reflect what the market is expecting. Currently, the market is expecting, good economic recovery, which in a way we are seeing as well, and the market is expecting inflation. So for the Aam Aadmi, this is something to be wary of. That's from the more from the common man point of view. For the debt market, of course, I've already explained. But you know what, Kirtan, I'll request you to stay on with us. We'll take forward this conversation. We'll talk about its impact on equities, and we will talk about how essentially investors should invest as well in both these categories of investments right after this very short break. So don't go anywhere, folks. You're watching The Money Show on ET Now. Let's continue our conversation with Kirtan Shah. We are talking about the spike in yields, whether you as retail investors should pay attention, and how should you essentially, even consider tweaking your investment strategy post this momentum that we have seen in yields. Well, let's talk about tweaking the investment strategy. So equity, you mentioned that, it sort of does tend to send jitters down equity investors. But for long-term equity investors and, long-term equity mutual funds, who most people usually are, should they really be bothered by this, Kirtan?
So, Mubina, in my opinion, this is going to be a short-term impact, and the long-term investors should not really bother. Look, what has happened is so much of money is come into the markets due to the ample liquidity available globally, that the valuations today look much more richer than it looked probably a year back. So if bond yields are going to spike, international investors are going to find an alternative to park their money, it is bound that some liquidity that came in over the last 8 months, 10 months is bound to go back, because of which the markets in the near term might have these jitters that they might see. But I think this is a short-term impact, is because if you look at the historical data point, it is not that every time yields spike, markets have reacted negatively. Over a longer period of time, I think if yields rise, but there is a rise in economic activity and the earnings growth is taken care of, it's absolutely not a concern. But currently what is happening is, a lot of things have come together with a lot of global liquidity coming in, the markets being richly priced in terms of valuation, which is why there is definitely going to be some impact in the shorter term. But I think long-term investors should actually use this as an opportunity to, kind of buy in the stocks or the MFs that they were looking at buying, but they could not because the markets were not giving them an entry point.
All right. Okay. Kirtan, let's now understand what should our strategy be. I mean, one thing's clear that we are seeing economic recovery. We are seeing signs of inflation as well. So this year, maybe we'll see at least interest rates staying steady, if not increasing. So one concept I wanted to talk to you about is rollover funds. How do you think that may perhaps fit into an investor's portfolio currently?
So, Mubina, rolling down concept is a very simple concept where, let's say, a fund house says that I'm going to buy bonds today, so I'm going to buy and position my entire portfolio today in a way that all of these bonds will mature at the end of the third year, right? So, typically, any investor coming into a roll down strategy should know that they are expected to hold on to this particular fund for 3 years, because the intention of the fund manager is buying the portfolio today with maturity at the end of the third year in mind, where the intent is not to buy and sell at all, but hold on till the end of the third year. So, in my opinion, these bonds or these portfolios called the roll down strategy portfolios will work right now, is because if yields are spiking up, we've understood how debt would give slightly negative returns in the near term. Right? This actually solves that problem, is because if you getting an investor to come in today, and if the maturity of the bond or the portfolio is 3 years, and the investor is going to hold on to the investment for 3 years, there is not going to be any mark-to-market loss that the investor is to be worried about, because the investor is buying the bond today There might be intermediary mark-to-market losses, but at maturity, the bond is going to give back the principal amount that was invested. And hence, this is the strategy that you can definitely look at investing in right now, because it will take care of the volatility, because a fund manager does not expect to move out of any of the debt in the interim. In fact, the concept is to hold on till the maturity. So you buy a bond today, hold on till the maturity, keep getting the coupons, and you are not bothered about the intermediate mark-to-market losses. I think that is why this strategy today makes sense for investors. So if there are fund houses offering roll-down strategies today, probably the retail investor should understand how long this roll-down strategy is to be implemented. In some cases, it may be 2 years, some may be 3 years. So once the retail investor understands that this roll-down strategy is for an X number of years, and if the investor stays invested till that time horizon, I think the volatility will not really impact the investor's investment in that case.
Would have loved to chat with you a little bit more on this, but I'm afraid we are a little short on time. So Kirtan, thank you so much for taking our time today and just explaining the basic concepts for our viewers. I hope they get some more clarity. They understand the implication of movement in yields on their overall investment portfolio and their money as well. And on that note, we will have to call it a day on this episode of The Money Show, because we have the GDP data that will be released in just a couple of minutes from now. So you'll catch the entire coverage right after this very short break.